Welcome back. Our next guest remains constructive on Mexican assets despite the recent violence in the country, saying the nation offers some of the highest real yields in emerging markets. Let's bring in Hadiza Djataou, VP and Portfolio Manager at Mackenzie Investments. It's good to have you join us. Thanks so much.
Thanks for having me.
So it's been interesting to see market reaction, Mexican market reaction to what's been happening over the last couple of days. Despite this violence that's kind of ensued, why do you think markets haven't really been reacting that much?
Because I think it is actually very constructive. When you look at this operation that is one of the most significant in past years against narcotics and cartels, it is really a big departure with this new government led by Claudia Sheinbaum and kind of in opposition with AMLO, the predecessor president, who was more trying to address, let's say, root cause of crime by increasing allocation to household and families versus having direct militarized confrontation with cartels. In this case, we also see a stronger cooperation with the U.S. because the U.S. were also U.S. intelligence was part of the operation, and that really set the stage really well for Mexico ahead of the USMCA renegotiation.
So do you think Mexico is now prepared to maybe take further action against drug cartels to satisfy Donald Trump ahead of the CUSMA renegotiations that are happening this summer?
Absolutely. And I think Mexico has been very consistent in delivering on ask from the new administration in the U.S. Another good example was late in 2025, they agreed to increase tariffs on Chinese goods, like broad tariffs across a certain category of goods, because one of the things that the U.S. administration is looking for is limit the access of Chinese goods coming through Mexico into the U.S. And this administration in Mexico is really determined to be able to deliver what the president is asking so that they can really secure the USMCA. Let's remember that 85% of export from Mexico towards the US are under USMCA, and that really protects us from a term of trade perspective.
Obviously, we're seeing these global tariffs imposed by Donald Trump, 10% U.S. administration working to get that up to 15%. How do you assess the impact of these latest tariffs on the Mexican economy?
Very limited. The increase and somewhat the struck down of the IEEPA tariffs were actually not really impactful for Mexico because, again, Mexico had 85% of their tariffs excluded from the IEEPA. Now, when you look at the breakdown, I think the big uncertainty is on sectoral tariffs, especially on steel. We know how much Mexico imports steel in the U.S., and I think the direction that the administration in the U.S. is going to take in terms of maybe expanding Section 301, which is the one that can be prolonged after 122, which is a subject, obviously, of 150 days to get approved by Congress. It's really the directionality that we're looking for. Mexico has been very compliant and very cooperative with the U.S., and I would expect that to continue. And that's also very interesting when we look at Canada. Canada has decided somewhat to take a different stance when it comes to negotiating, and ahead of the USMCA review, I still remain very, very bullish on Mexican asset compared to Canadian asset in particular.
Very interesting. When it comes to Mexico as kind of an emerging market for a lot of investors, what sectors of the Mexican economy do you think have the most potential for growth in 2026?
I think AI, expansion of data centers, for instance, is going to be another tailwind for Mexico. I think export of commodities, the search for commodities and the bid on commodities has been significant. I think is going to continue. Mexico is one of the largest silver exporter. That is going to continue, obviously. Also cars. There is a lot of diversification, actually, when we look at the breakdown of the Mexican economy. Tourism is going to be impacted by the recent event. Let's be realistic about it. But when we look at the GDP breakdown again, Mexico's GDP account for about 9% on tourism, maybe 15% when you account for an indirect effect. But I would expect that to be manageable because there are other drivers for growth going forward, and commodity would be a big one.
Just very, very quickly, you have a constructive outlook on Mexican bonds as well. Why is that?
Because first of all, they offer a very attractive all-in yield. You can get 7% for short-term maturity. I do think that the central bank is really willing to cut rates further. They have started the easing cycle. Inflation has come back within their target. They have communicated very consistently that the real policy rate is still too high in Mexico and it needs to come down. And I would think that they will likely cut rates again in March, which would be supportive not only for local bonds, but also somewhat from the currency, because the currency, again, is going to get tailwind from flow of assets. We know this narrative around diversification away from U.S. equities, for instance. If you look at Mexican equities, they performed about 30% last year versus 16% for S&P 500. And I believe that that performance and outperformance of Mexican equities will continue and will drive flows towards the asset class.
Okay, Hadiza Djataou, VP and Portfolio Manager at Mackenzie Investments. So good to have you join us. Thank you.
Thanks for having me.